Welcome back, everyone. Today on the Joseph Carlson Show, Elon Musk has decided today to go to war with Apple and their dreaded 30% take rate from the App Store. He has this meme that he put out, pay the 30% fee, go to war, and Elon Musk is choosing war. I'll give you my opinion on not only who I think will come out victorious of this war, but also I think some important information regarding Apple's take rate. We also have some stunning news of possibly the best investor to ever live. This guy, Ted Weschler. He's a very unassuming looking guy, but Ted Weschler is one of the employees at Berkshire. He's one of the top lieutenants. He's going to be taking over a large role after Warren Buffett and Charlie Munger pass away. And we had some recent news revealed about Ted Weschler that he managed to turn a $70,000 retirement account into $264 million. This is possibly the best performance I've ever seen of any investor ever. This trumps all. I've never seen anything like this. So we're going to dive into this and see if Ted Weschler is the best investor alive today. So of course, we have a lot to jump into in this episode, a lot of exciting news to get to, and we'll be doing a portfolio update as well. We've had some exciting changes and I think positive changes to my portfolio. Now, before we jump in, just a quick shout out to today's sponsor. It's Qualtrim. Qualtrim's a website that I own and built, and I built it with a coworker at my previous development job. Now, Qualtrim has all these different aspects to it, but the main one right now is Qualtrim Insights. This is the portion of research that you see me use with all of these charts and graphs. There's many websites that do this, but I really don't think they do it as well as Qualtrim does. It is the most simple view to get all the key fundamentals of a company on a single page. And everyone that uses this website, the huge majority say that they love it because it saves them so much time compared to other ones where they have tons of data that's unnecessary for stock analysis. So if you want to try this software out, you can do so by joining the Patreon. There's a link in the pinned comment below. That's right, there's a battle brewing between the company that's my largest holding, which is Apple, and Elon Musk. Elon Musk has set his sights on his next target, which is Apple. And you're going to see this battle explode over the next couple of days in the news and across YouTube. We have different tweets here. Elon Musk says, Apple has mostly stopped advertising on Twitter. Do they hate free speech in America? He specifically tags Tim Cook, saying, what's going on here? At Tim Cook? So that's the first accusation that Elon Musk has launched at Apple. They're pulling their ad budget off of Twitter. Now, obviously, there's a number of reasons why Apple would do this. They don't want to be associated with a company that's allowing on a lot of unsavory people, lots of different opinions shared that aren't really something that the Apple brand may not want to be associated with. So Apple has clear reasons why they could say that they're holding their ad budget off of Twitter. They're not the only company to be doing this. There's many companies that have pulled their ad budgets off of Twitter after Elon Musk took over. But Elon Musk is now becoming the most upset at Apple, and the tweets don't end here. Elon Musk retweets one that says, during COVID, Apple demanded our apps filter some search terms from being returned. If we did not filter the terms, our apps would not be allowed in the store. Apple may make good products, but they have been opposed to free speech for some time. And Elon Musk retweeted that saying, who else has Apple censored? Calling upon all of his followers, come together and show examples of who big bad Apple has censored. He then quickly retweeted the ad that Fortnite did, Tim Sweeney, that made a 1984 parody video calling out Apple's monopoly. And he says, accurate. This continues on. Right afterwards, he does a poll saying Apple should publish all censorship actions it has taken that affect its customers. We can see how many people voted for yes. I'm assuming the large majority. There we have it, 86% saying that Apple should publish everything that they've censored. Just 12 minutes ago, he tweeted, Apple has also threatened to withhold Twitter from its App Store, but won't tell us why. Now Apple's such a big bully that they're blocking Twitter and they won't even explain why. Did you know Apple puts a secret 30% tax on everything you buy through their App Store? He retweeted a tweet saying that Apple takes 30% from app developers who make over 1 million through the App Store on an annual basis. Now that's not exactly true. It's 30% for the first year and it goes to 15%, and Apple does not take a fee from the large majority of apps in the App Store. For example, streaming services, reader apps, there's lots of different ones that they take no fee on at all. Apple's also recently modified this policy just 2 years ago, making it so that their take rate's even less for smaller developers. If you make less than 1 million per year, the take rate from Apple is only 15%, not the 30%. It moves to 30% after the first 1 million. So really the only people that are paying this 30% take rate are developers that are making over 1 million per year. This is a little nuance that Elon Musk is sort of leaving out because it paints Apple in a better light. For the majority of their developers, the ones making less than 1 million per year, Apple takes 15% and lets the developer keep 85%. But regardless, Elon Musk is making the case here against Apple's take rate. And then finally, the culmination of this, just minutes ago, Elon Musk tweeted out, pay the 30% or go to war. Now let me first just mention that I am biased here. I own a lot of Apple stock. I've owned the company since 2017. I've held it for some time. I'm in the green by about $13,400, and it's a very meaningful position. It's around $50,000 of my portfolio. So I'm heavily invested in this company, and at the same time, I own no Tesla. Now, having said that, I'll try to give my take as unbiasedly as possible and look at this as objectively as possible. What Elon Musk is arguing here is really nothing to do with free speech. It has nothing to do with free speech. He doesn't care what Apple censors and what they don't censor. That's not part of the argument at all. All the free speech talk is a facade for being upset that Apple has a high take rate. They take 30% of in-app transactions for the first year if they're reoccurring transactions. After the first year, it moves to 15%. So it gets cut in half. Meaning that when Elon Musk charges you his $8 for Twitter Blue, if you sign up through the App Store, 30% of that $8 per month goes to Apple. And then after the first year, it goes down to 15%. And it remains 15% in perpetuity. That's for only people that signed up through the App Store. If you sign up for Twitter Blue through the website, you don't pay the Apple take rate, even though you use the app on the iPhone. So all of it comes down to where you sign up. And many companies have dealt with this by simply redirecting how users sign up. They bypass the App Store take rate by saying, hey, just sign up online. That's what Netflix has done for literally 5 years. Netflix has grown substantially by redirecting people outside of the App Store to sign up for Netflix. And then they can view their shows on Apple devices after signing up. So Elon does have other ways of going around this. He could simply say, hey, to sign up for Twitter Blue, just sign up outside of the App Store. Here's a link. Apple now allows you to do that, and it's really not that difficult. So I don't see this as much of a permanent problem. Most companies like Netflix or like Hulu or like HBO Max have all been able to direct people outside of the App Store to sign up and avoid the Apple take rate. All Elon Musk needs to do with Twitter is literally put a link that says sign up for Twitter Blue, here's the website link. Users can go to the website and pay online. That's not a very difficult thing to do, and I think most users would do that just fine. I think that's the easiest solution. But Elon Musk doesn't seem interested in having the easier solution. He doesn't seem interested in inconveniencing his users by having them sign up on the website. Rather, he wants to go to war with Apple. The problem with this battle of claiming that Apple's take rate is too high is by any comparative or relative take rate, it's actually not that bad. It's actually not as bad as most people consider. Here's a tweet I put out a month ago on this very subject. Let's put this in perspective of different companies and their different take rates. Meta and Instagram get 100% of the revenue and they give you back 45%. Twitter, for example, right now, pays you nothing as a content creator. I can generate millions of impressions, hundreds of thousands of likes and tweets and content that Twitter monetizes, and they give me back nothing. Twitch, which has been around for a long time, owned by Amazon, gives back 50%. So out of all the Twitch Prime subs, out of all the ads they run, they give back creators only half. YouTube's a little bit better. In fact, I think YouTube's on the good end, but they announced for YouTube Shorts that the sharing is even worse. They keep 55% and they give you 45%. So even YouTube is somewhat Twitch-like with their new YouTube Shorts. With their long-form format, which is mostly what I do, they still keep 45%. Apple takes 30% from creators. If you go through their store, their app, their platform, they keep 30% and they give you 70%. So I look at this in context and I compare all the major social media companies, all the major tech companies, and I put them side by side. Twitter is the worst with creator sharing. Right now, not only do they take 100% of revenue from creators, they share nothing back with you, but they're also charging you $8 per month to verify, so that you can have your followers not be tricked by imposters. So Elon Musk is complaining about Apple's 30% take rate, while Twitter's take rate effectively right now from all of its content creators is 100%. They don't share anything. And by contrast, as someone that has apps both on iOS and does content on Twitter, I much prefer Apple's take rate as a creator. I'd love it if Twitter gave me 70% of the ad revenue I generate with my tweets. That would encourage me to tweet far more often, to make far better content on Twitter. But as it stands right now, I get really nothing in return other than some additional exposure. The real money that creators make is not based off of Twitter. Most of Twitter just serves as a link back to your YouTube account. YouTube is where you get the ad revenue, and the App Store is really where you sell products. So I look at this overall, and I think that Elon Musk has a very weak argument here. But regardless, I still think enough noise could cause a change. This is something that could actually incur a change with Apple. The truth is, Apple's just too big. That's the problem here. It's not that they have a high take rate. The problem with Apple is they're simply too big for their own good. When you get to a certain size, when you're a certain profitability, you become the target whether or not it's justified or not. And even though in this case, I don't think it's really justified for Apple to be such an intense target based off their 30% take rate, I think they're going to be a target anyway. That's something Apple has to deal with. Apple's by far the most consistently profitable big tech company in the market. Their revenue grows substantially, 10% over the past 10 years, 18% over the past 2 years. They're an incredibly massive and continually growing company. And I've highlighted this many times. Their EBITDA numbers are just wild. Last quarter, they did $28 billion in EBITDA. Their free cash flow is over $20 billion per quarter like clockwork. Other big tech companies like Amazon, Meta, Google, and even Microsoft have difficulty keeping up with this. Apple is one of a kind with how massive, how powerful, how profitable this company is. So regardless or not, whether or not it's justified, Apple is the target. They're the king of the hill. They're the one that everybody's gunning for to knock down, whether or not that's justified. And in my opinion, I think Apple should lower the take rate of the App Store, regardless of whether or not it's justified. I think it should come down. Because even though 30% is not as bad as a lot of other companies like we've highlighted, it's still a lot. Taking 30% from developers is a good chunk of their work, and I think in many cases it's simply not warranted. Apple does have massive distribution, they've built the company, they own the company, but I think they'd be highly successful taking 20%. Lowering it and allowing their app developers to take a bigger portion of the gain. In fact, I think that may actually lead to better relationship with developers, more loyalty, and a better long-term Apple overall. So even though I don't agree with the basic premise here, that Apple's unfair and that they take too much money, in compared to other companies, I think that's a hard argument to make, I do agree with the outcome here. I think that Apple should lower their take rate, and this is something that I've argued for a long time. Apple is positioning themselves as a service-oriented company. A large portion of their profitability does come through their App Store, so it would take an immediate hit if they lowered their take rate. You'd see profitability drop in the short term, but I think over the long term, they're positioned to outgrow that hit. And they'll do that through subscriptions. I've outlined this many times. Apple is a subscription company. They have over 800 million subscribers, and their incremental profitability they can generate just by charging $1 more per month on these subscriptions is substantial. It's in the range of $10 to $25 billion per year. That's an incremental profits from a $1 price increase. This is another way of saying that even if Apple does lower their take rate from the App Store, I think the company still will grow in profitability. I don't think this will be a long-term headwind. And in the meantime, with them charging 30%, it puts the spotlight on Apple. It puts all the criticism on them, and it makes them a target for regulation. So we'll see what Apple does, whether or not they argue against this, whether or not they make any statements at all. But my prediction is, once again, the App Store fees are eventually going to come down. I don't know how it's going to happen, but I think it's going to go down from 30% to 20 or 15%. I see that happening in the not too distant future. And I think that even so, Apple's doing preparations right now, and I think they'll be just fine. Now, before we jump into the news of Ted Weschler's Roth IRA, I want to do a quick portfolio update. This is the passive income portfolio. Many of you know it as a dividend growth portfolio, but this has really evolved over time. Instead of primarily focusing on dividends or the dividend payout ratio or the yield of the portfolio, I've changed focus to some degree on the actual compounding natures of the company, characteristics that I think lead to compounders. And I've outlined compounders in 6 different steps. These are not just my personal opinions. Each of these points are backed by a lot of research that show that these type of companies lead to better risk-adjusted returns. So even though dividends and buybacks do remain an aspect of the portfolio, The overarching theme here has been moving towards high-quality compounders that are extremely durable and unlikely to be disrupted. These are companies that I consider to have significant moats. I bought into companies like Costco, because Costco has a significant moat, especially for a retailer. I think it's incredibly difficult to disrupt this company. The same can be said for Nike, Pepsi, and Estee Lauder. These are three companies that I've been buying into heavily over the past couple of months. I recently built up a brand new position in Estee Lauder to be around $7,500. And this is a company that's very, very difficult to disrupt. They have a nice corner carved out for themselves in the beauty industry. In the restaurant category, I've bought into two companies, Texas Roadhouse and Starbucks. Starbucks is one that I think has incredible brand value. I think it has a lot of key real estate with their locations, and I think it's ubiquitous with morning drinks and coffee. And they're now moving into more fast foods, single-handed foods that people can get on their way to work. This is a company that I think I'll get substantial returns from. Texas Roadhouse is a smaller company, possibly more risky because it only has a $6 billion market cap. But this is one that I think the management team is incredibly disciplined. They're very good at running this restaurant. I do think it has substantial brand value. I think it has customer loyalty. I think it has a very value-oriented product that will hold up well against competition. And this is one that I was buying into the 70s, and now the company's trading around $100 per share, plus it pays a very hefty dividend. So I'm currently in the green by $6,600 on this one. And this is a new holding this year. Texas Roadhouse is one that I hope to make double or even triple my actual initial investment on. So right now it's at $40,000. I'd love to have this one grow to $60,000 and $80,000 over time. And I think this company can do it. Now, I have made some changes. I've made a couple partial sells, and then I've made a couple buys. In the financial category, I sold entirely out of T. Rowe Price. That should not come as a surprise. I've held T. Rowe Price for over 3.5 years, and the company was a very small position. For the majority of the lifetime, I had only $1,000 invested in it. At one point, I had up to $2,000, and the overall gains were only $200. So this was a very insignificant position. T. Rowe Price is a company that a lot of dividend investors really love because of the high yield, but I think the company has some significant downsides that dividend investors should be aware of. First of all, the company is highly volatile. It trades down significantly during any market sell-off. In the past quarter, the earnings are down 50% from a year ago. This is an incredibly volatile and often unpredictable company. Also, what T. Rowe actually does, what they specialize in, is actively manage growth funds, market-beating growth funds. And that is a very competitive space. This company faces a lot of competition, both with ETFs that have lower expense ratios, but also with other actively managed funds. And I think there's significant risk there. If T. Rowe Price's funds don't outperform the market, or if the market shifts from growth to value, I think this company may struggle to attract assets for a long period of time. The one thing that they really have is a history of outperforming the market with their actively managed funds. And if that goes away, I think it may be a long road to recovery. So this is a company that I also think faces fierce competition, and I think it's just generally less predictable than I would like. So I sold out of my T. Rowe Price position after holding that one for around 3.5 years. The next company that I sold part of was I trimmed my JP Morgan stake by $7,000, which is around 1/3 of the stake. The reason I trimmed this position is because this company has done very good, and I think the valuation has run up to a very full valuation. JP Morgan now trades at a 1.6 price to book. This is far more expensive than when I initially purchased the company. It was trading around a 1.1 to 1.2. And I think the company right now is around a full valuation. It might get up to a 1.8. It possibly could. But I think at a 1.6, it's fully valued. And I have significant gains in this company. I'm in the green by around $6,000. And a company in the financial category I think is more volatile and cyclical than other companies. So I've sold 1/3 of my stake in JP Morgan, which is around $7,000. Basically my gains in the company. And I've decided to redeploy these funds from both selling T. Rowe Price and part of JP Morgan into industrials. In the industrial category, I have two companies here, both Class 1 railroad companies. We have Canadian Pacific and Union Pacific. Canadian Pacific is a company that's trying to do a merger that would make it so that they have a railway all the way from Canada through the US into Mexico, which would give them a significant competitive advantage. That'd be something that they could really try to optimize and increase their cash flows substantially from. So that's a good tailwind for this company. The deal is likely to go through, but this is still an incredibly good company even if that deal doesn't go through. Union Pacific is a Class 1 American behemoth railroad. It's just massive. And this company is doing the same thing it always has. It generates significant free cash flow. It's growing its free cash flow per share on a steady basis. And both of these companies have steadily beaten the market over the past 20 years, almost in every various timeline. These companies all possess the same characteristics. First of all, they're heavily insulated and incredibly difficult to disrupt. They're basically oligopolies, and they have an inherent monopolistic nature. It is impossible to rebuild what these companies have built. So if we're talking about companies that are difficult to compete with, try to imagine a company that starts up a new railroad. It is literally impossible to do. It's never going to happen again in the United States. So the railways that exist right now are the only ones, the only Class 1 railroads that will ever exist going forward. So they're heavily insulated and monopolistic. The barriers of entry are incredibly high. But not only that, they also have good economics. Being a monopoly is only a good thing if you're a monopoly of a business that has good economics. And these companies, fortunately, do have very good economics. All of them continue to grow their free cash flow substantially while not diluting shareholders. Their stock-based compensation is basically non-existent. Their leverage ratios on their balance sheet are completely reasonable. $26 billion in debt when they did $12 billion of EBITDA last year. They can easily maintain and handle their debt. These companies aren't over-levered. The dividend growth of either of these companies, Canadian Pacific or Union Pacific, is substantial, somewhat of the best in the market. They've grown their dividend by 17% over the past decade. Just last year, they raised it by 21%. They're not only paying you in dividends, but they're also paying you in equity by reducing the share count every single year. Over the past 10 years, Union Pacific has on average reduced their share count by over 4% a year. They're just devouring their shares outstanding. In the last year, the pace hasn't slowed down, minus 4.36% shares outstanding. That's a result of their substantial free cash flow being redirected into both dividends and buybacks. And these railroads, unlike airlines or auto manufacturers, have a history of very high returns on capital employed. Union Pacific's is around 16 to 18%. This isn't the highest in the market. They do have some CapEx spend, but this is much higher than the cost of capital. They earn a continual good return on their deployed capital. So I could go into more detail on these companies and do a deep dive, but I think the investment thesis is pretty simple. These are oligopoly, monopolistic companies that have high barriers to entry, that routinely earn high returns on capital employed, that pay growing dividends and do substantial share buybacks, and they generate non-diluted free cash flow that continually grows year over year. And I think in the future, they're also very unlikely to be disrupted. I don't think that EVs are going to disrupt them, and I don't think that electric trucks will be disrupting them. These are by far the most efficient way to move stuff across the country. So there's the portfolio update for today. You may disagree or agree with the buys, but either way, I'm going to continue to show every single thing I do with this portfolio and try to explain the reasons I'm making these decisions as best I can. Overall, I'm very happy with the performance of this portfolio. I think it's great to be $43,000 in the green given the year that we've had. I put a lot of money in this portfolio in 2021, so it's been difficult to keep this portfolio in the green, but it has been holding up really well. Now moving on, we have some stunning news, just some incredible news about an individual named Ted Weschler. Now, he's not that glamorized, this guy isn't that popular, and he's most known for being one of the lieutenants, one of the main guys at Berkshire Hathaway. Warren Buffett hired Ted Weschler to be part of Berkshire after he bought 2 different charity lunches to sit and chat with Buffett. And Buffett was so impressed that he said, "Hey, I want to have you as part of the team here, come and join Berkshire." Ted Weschler initially said no, but decided to join the company. Now, it's a bold claim to say that anyone might possibly be the best investor alive and actively working today. And I say that with a lot of hesitancy about Ted Weschler. Buffett, with Berkshire, is largely considered to be the best investor alive, and the results speak for themselves. You have funds like Tiger Global or ARK Invest that can do well over a period of time, but it's difficult to beat Buffett's performance over a long period of time. The performance of Berkshire Hathaway since inception is 3,641%. 3,641% compared to 30,000% for the S&P 500. So his performance wildly beats the market over a very long period of time. It's around 20% annualized since the very beginning. Having 20% annualized returns since 1965 is incredible, and there's really nothing else like it. So Buffett has remained the king. He sits on a throne of the best investor alive today. Then we have some news come to light about Ted Weschler, and this news again is stunning. They say that unless my calculator was having a meltdown, his IRA had outperformed Berkshire stock by about 120 to 1 from 1989 to 2012, and by almost 90 to 1 from 1989 through 2018. 90 to 1 outperformance of Berkshire from 1989. And of course, his IRA outperformed the S&P 500 by an even wider margin. So he outperformed the S&P 500 by over 90 to 1. That's pretty impressive. Now, Ted Weschler actually responded to emails and put out an official statement regarding his Roth IRA. The first thing that he says is, to be clear, I do not think that you sharing this information is appropriate. So he was actually upset that this information came out. He didn't want to expose his incredible performance. It wasn't something he wanted to brag about. He says that it was inappropriate that they got access to this information, which is true because this is supposed to be private information. He says, nonetheless, I appreciate the opportunity to contextualize it. He goes on to explain that everything he purchased were public stocks available for anyone else. He had no special deals, no special treatment, and the results are not a result of him not paying taxes. But he's also incredibly humble. He says the investing success of this account has been a function of careful stock selection, exceptional luck, and a multi-decade time period. So in this, he's humble enough to say that a lot of this is luck. He isn't trying to build himself up to be a grandmaster of stock picking, which he very well could do with these type of results. So not only is his performance just wild, but his attitude is very humble. He says that this could be used for a learning experience. He encourages others to invest early and invest often, and it's okay to make mistakes. He repeats that over and over again, saying it's okay to make mistakes with investments. Don't become discouraged just because you have some losses for a period of time. In 1990, Ted Weschler's Roth IRA had a 52% loss. Half his portfolio gone in just 1990. He says, quote, one of my personal investment mantras is that there's no such thing as a loss, it's just an unmonetized lesson. That is clearly the perspective of someone that does not become discouraged. They learn from mistakes and move on and do better in the future. And again, he reiterates that he's fine with the tax policy changing on Roth IRAs, saying, quote, to this end, I am openly supportive of modifying the benefit afforded to retirement accounts once they exceed a certain threshold. So what I find so impressive about Ted Weschler is, first of all, his superior returns. There's not many people on planet Earth that can turn $70,000 into $264 million. Simply put, that's just hard to do. And to do that, you have to be a good investor. That's not just getting lucky once or twice, that is consistently having extremely good analytical skills, extremely good security analysis, and making smart judgment on a continual basis. But not only that, he's incredibly humble. He downplays it, saying that he never wanted this to become public. It wasn't something he wanted to brag about. And he says that a good portion of this is just luck. He was just lucky, right? He downplays it as much as possible. And then he's also fine adapting tax policy to tax his ridiculous gains at a higher level than what the Roth IRA really should. Because the deal that he got right now is that the gains would not be taxed. So the fact that he's willing to change that and say, I'm supportive of that changing, also speaks to his character. So when I look at Ted Weschler overall, I see a very impressive individual here for a lot of different reasons. But this also has more meaning than just Ted Weschler. A lot of people are concerned of what's going to happen to Berkshire Hathaway once Charlie Munger and Warren Buffett eventually pass away. What's going to happen with this company's management? Well, Ted Weschler is one of the main guys doing security analysis at Berkshire Hathaway. He's one of the ones over their portfolio and the decision making on their investments, along with Todd. You have Ted and Todd making most of the big decisions. I think there's a good chance that Ted Weschler taking over a bigger role at Berkshire may actually lead to superior results. That's right. I think the company may actually have better results than the past 20 years. In fact, if we go back 4 months ago, I did an episode on the truth behind Warren Buffett buying Apple stock. This is Warren Buffett's best investment over the past 20 years. He's made more money with Apple than any other company. He invested something like $27 billion. Now the holding's worth well over $100 billion. So it's been a massive success. And Warren Buffett wasn't the one that came up with that idea. The one who really encouraged Warren Buffett, who begged him to buy the stock, who went in and explained how Apple is dramatically undervalued, how the company's basically a consumer staple, how people are addicted to their phones, and Apple has a lot of ways to monetize, was none other than Ted Weschler. Since joining Berkshire, he's the one behind Berkshire's best stock pick over the past 20 years. So to me, this is an encouraging thing for Berkshire Hathaway. You know that one of the key individuals running this company after Warren Buffett and Charlie Munger's death is going to be someone that's an incredibly skilled stock picker, that has a humble attitude, that has a balanced, level-headed approach to investing, and has a long history of generating far superior returns to the market. So in my opinion, this speaks very positively of Berkshire. I think this company's in very good hands. I thought even before finding out this information that Berkshire Hathaway with all of their assets would outperform the S&P 500, but I'm even more confident now. These are not your average executives, not your average individuals running these companies. Now that's all the news for this episode. I'll have more updates in the future on my portfolio and some of my holdings. I'm building up a lot of different positions right now that I think will do really well over the next couple of years. So if you haven't already, subscribe to the channel, and I'll see you in the next one.